Okay, thank you, Casey, and good morning, everybody out there, and welcome to our seminar this year, which was entitled, not surprisingly, Singapore Budget 2021, and Beyond. And part of the reason for the Beyond is because, as most of you will already know, if you've been reading the papers, if you saw the output from the Ministry of Finance on Tuesday evening, Budget 2021 itself carried very few changes as far as tax is concerned, but we'll be looking at those. But we'll also be looking beyond the budget and the things that perhaps weren't in there, and some of the pretty meaty issues that we believe still need to be addressed in order to get Singapore back on the road to recovery and to continued growth. So Casey, what we'll be looking at today. So as far as Budget 2021 is concerned itself, I'll be just giving a quick overview and some general comments as to what we thought about the content of the budget. And then we will be taking a look at the year in retrospect, which is just a quick run through of some of the things that happened last year, not going over or raking over all the coals in terms of the various budgets that we had, but picking out some of the important landmark issues that we came across. And then we'll be looking at the corporate tax changes, the personal tax changes. Personal tax will take about 3 seconds, and then goods and services tax, which I think has some of the meat in. Now, joining me this morning, before I get to Beyond Budget 2021, is Law Eng Min, who is our leading lady and tax partner, who is essentially the backbone of our department, and she will be taking us through those budget changes and a stroll down memory lane of last year. We've also got Jeremy O'Neill, who is a senior manager responsible for goods and services tax. He'll be taking us through some of the detail of those changes. Adrian Sham, head of global mobility and remuneration services. He'll be looking at changes in the workplace later on. And then last but not least, Munjal Al-Mullah, who is our head of transfer pricing. All of these areas we're going to be talking about primarily in the Beyond Budget section. And so what that's going to be about is looking at our areas of concern that we see going forward, and a few elephants that are in the room. Real estate, I've got some possibly radical things to say around that, so make sure that you're sitting comfortably before we get to those slides. Demographics, a bit of a blind spot, I believe, in terms of Singapore's future, which, despite demonstrations on our part for the last 15, 20 years, the message doesn't seem to have got home. The engines of growth for Singapore going forward, entrepreneurs and what we can do about building up that particular area of Singapore's future. And then, of course, things that we've seen, changes that we've experienced over the last year, which have probably changed our lives forever. The future of the workplace. What is this all going to look like in the years to come? And what are some of the tax issues that fall out of that? Transfer pricing is going to be a big issue. This isn't going to go away. And as Munjal will tell you, we're going to get into the middle of a transfer pricing war. So be ready for that. And then finally, Jeremy will give you a couple of pointers on things to do in the eventual event of a hike in the GST rates, what to do over those transitional periods, so that you can all get your minds around those things. So without any more on that, we'll take a look at what we thought of Budget 2021. Probably don't need to spend more time or much time on this. You'll have seen all these pieces from the press as we went. The budget was broken down into a number of categories. First of all, the resilience package, and that was all about trying to keep things afloat until the mists cleared and until the economy could get back on its feet. And a lot of that was around extending the job support scheme, but in a more targeted way than we'd seen last year, with category 1 and 2 businesses being extended. It was going to require dipping into past reserves still, but that is an inevitability for the time being. The other category was how we emerged with a stronger and skilled workforce and innovative businesses. Now, this isn't a new theme. This has been around for a long time, but it was all about the government facilitating an access to capital to enable job upskilling and the creation of these, shall we say, skills transfer programs. More on that in a second. The other piece, which was just transforming the entire value chain, rather than just concentrating on giving growth spurts to individual businesses, looking at the whole end-to-end value chain. So, Casey. Strengthening the social contract. Well, that's all about sitting around the campfire, hugging and kissing each other, and looking after each other. Some extensions of charitable giving, tax relief came as part of that. And then, of course, the green piece, making Singapore a sustainable home for everybody, built around an agri-food cluster, getting rid of petrol-driven cars and becoming a car-light society, which obviously involves lots of infrastructure projects, and around that, some government borrowing through these so-called green bonds. And then pulling this all together, financial strategy. Basically, this is all around balancing Singapore's immediate cash needs and the longer term needs for future generations. As we saw with the resilience package, we're going to continue to be drawing on past reserves to help get the economy through the worst. But then once we're through the worst, we've already got announcement of the inevitable tax hikes on GST. That, should it be sufficient, is going to help fund the immediate needs on an ongoing basis, on a year-on-year basis. But when we're looking at longer term infrastructure projects, because they will benefit future generations, the government is intending to issue bonds and effectively borrow for those projects, so that the cost of them is not borne by the people that are only there at the front end and don't get the opportunity to use them. So what did we think about it? Well, actually nothing new or unexpected, and we weren't expecting anything anyway, because what we saw in the budget was consistent with the message that we've been seeing all throughout 2020. There was very little more juice to squeeze out of the budget lemon. We had one main budget and 3 other mini budgets last year. So within the space of a year, we've had 5 budgets. Nothing unexpected, nothing new actually came out of this year's budget. Our almost universal reaction to it, though, without anyone prompting it, was that it was a very domestic and I would call insular, which in the context of Singapore is an apt adjective, sort of budget. It looked at, you know, upskilling Singaporeans, giving money to everyone to stimulate their businesses, etc., etc. But it didn't focus on the external threats that were out there. There was some vague mentions of sort of, I suppose, China, US, trade wars, etc., etc., but nothing that seemed to suggest that there was anything out there to worry about. And of course, I think we all know that there's lots to worry about, and there was nothing about what those threats might be and how we're going to face them. It was all very inward looking, staring at your navel, if you like. And the other interesting thing is that foreign talent and the availability of foreign talent was sort of dismissed as if it was a tap that could be turned on and off. And as we'll see from Adrian later on, be careful what you do with foreign talent, because there's plenty of competition for it, and there are plenty of other opportunities now, rather than coming to Singapore. And so that is something that really wasn't focused on, which I do think needs some focus. Unfortunately, as I mentioned, no meaty tax issues for us. It was all about handouts and how we were going to fund those handouts in the short term and the longer term. And the other slightly disturbing thing was we all assume we're going to emerge from something, but we don't know when that is going to be or what it's going to really look like. However, the minister did at least hint that if our emergence was derailed or took longer than expected, whatever expected means, then he may be inclined to dip into more reserves. So it wasn't a panicky budget. It was very well measured, very well thought out. But as I said, no surprises. So on that note, I will hand you over to Eng Min, who is going to take you first of all through the year in retrospect, and then the actual budget itself. So thank you.
Right. Thank you, David. Good morning. Okay, 2020 was really an unprecedented year. 5 budgets and 2 ministerial statements. Lots of extension of terms granted by IRAS changing the rules. So what I would do is that I'll do a quick walk down memory lane on some of these rules, and then focusing on the COVID-19 related one first, and then the rest. Now, I think for the COVID-19 related corporate tax measure, the most significant one is basically how the payouts that's been given out to the companies will be taxed. I think the significant one will be JSS. I think lots of us receive JSS. So what IRAS has done is that IRAS has provided a list of payouts, and then you can actually go in and check as to see whether this payout would be taxable or will be tax exempt. It's not as intuitive as before. So what I can tell you is that, for example, JSS is specifically exempt from tax by the IRAS. And when it comes to some other sort of a payment, like some expenses that you incur, and you get a grant to defray that cost of incurring those expenses, those will be considered taxable, but you get to claim the expenses against it. Whereas JSS is given to make sure that locals can keep their job. So although on the one hand, you pay wages to them, salary to them, on the other hand, when you receive the JSS, that part of it is exempt from tax. So do remember to exclude it when you do your tax provision. Now, the other sort of like a concession that the IRAS has given is on tax residency of companies. So what you need to do is to ask yourself, do you need a COR from IRAS? And just by way of a background, before IRAS grant you a certificate of residence, the first question they will ask you is that, did you hold any board of directors meeting in Singapore? Because of COVID and because of travel restrictions that come about with COVID, a number of companies will not be able to hold meetings in Singapore. They may do an online meeting. They may actually hold a meeting overseas. So IRAS is prepared to disregard the fact that you did not hold any meeting in Singapore in 2020 or even 2021, okay, and continue to grant you the COR if you meet certain conditions, one of which is there's no change in your economic circumstances, and the company is a resident in the year immediate, in the immediate prior year. So if you are looking at 2020, if you're not sure whether you need a COR, you also have to consider whether you need one in 2021. If you need one in 2021, you may have to make sure that you also meet the conditions in 2020, because before granting you that COR for 2021, you have to meet it in the prior year. So you need to basically look at your position and see whether you need to do anything about it. And all IRAS require is evidence of why you can't hold meeting here, evidence of what you have done, and evidence of you being a tax resident in the year before. So that's an assessment that you may need to do. And then IRAS has also relaxed, the PE definition. So what it means is that if you are a foreign company and somehow you happen to have employees stuck in Singapore, working in Singapore, and based on the treaty, based on the local rules, if you exceed a certain number of days, and then basically the foreign company would have a PE in Singapore. And what the Singapore Revenue has done is that they are saying that, okay, if these people are here and they can't leave Singapore because of the travel restriction, and their presence in Singapore is actually temporary, and what they're doing here in Singapore would not have been done in Singapore before. So in this sort of situation, they're prepared to consider that you do not have a PE in Singapore. So by the same token, a number of you may have got employees working in Malaysia, working in Indonesia. So you may have to check whether these people working in these other countries would create a PE for your company. So if you have a PE exposure, there's always a question of what sort of profit needs to be attributable to that PE, and whether you have any tax filing requirements in those countries, and if you don't, whether there are penalties. Right, so I'll move on to the next slide. Now the first one on taxation of digital, okay, sorry, just one step back. I've actually chosen these 6 items, when I look back, and I thought some of them will be interesting to you. Now, the first one, I don't intend to do much other than tell you that we have a seminar, Cryptos Aren't Just for Christmas, on taxation of digital tokens, which will basically tell you about, the accounting treatment, the tax treatment, which is broken down into the direct and indirect tax treatment. So if you're interested, I mean, if you have dealings in this, I think it'd be good for you to just have a look at it, because it's a new circular that was introduced last year. Now, the next one that I'm looking at is the Form CS Lite. Form CS is already light, but it's even lighter now. And this one, in terms of the revenue level, it's 200,000. So you can, they're just wanting to make it simpler. So if you have like small little companies within your group, you may actually qualify for Form CS Lite. And then the other one that I'd like to share with you is on designated bank accounts. Now, for the longest time, IRAS had said that for a designated bank account, by definition, is capital. If there's any exchange difference on it, it's a capital in nature. But if this particular DBU is used for you to receive trade receivables and to make trade payables, if there's any exchange difference on it, IRAS is prepared to consider the difference to be a revenue exchange difference. But of course, exchange difference being exchange difference, it cuts both ways. It could be a gain or it could be a loss. And if it's a loss, you can take a deduction. So come YA 2020, IRAS introduced what we call a de minimis rule. And basically what they're saying is that if you have not more than 12 capital transaction in a year, and the total value of the capital transaction is not more than 500,000, so they accept that, having this sort of transaction will not taint the account. The account would still continue to be a DBU, and if you have any exchange loss on it, you can continue to claim tax deduction on that. All right, so for people who are interested in VCC, a new tax framework has been introduced, basically treating a VCC as a company for corporate tax purposes. And then there's some variation to that treatment. And for stamp duty and for GST, each sub-funds will be treated separately. So if you're interested, if you have an interest in this, or if you're involved in some VCC, it'll be good for you to take a look at it, or come to us if you have any questions. And the next one that I wanted to cover is on digital tax. Now, digital taxes is going to be more prevalent with countries, stamping their right on this e-commerce transaction to say that they have the first right to tax it. So IRAS recently just, have a flash on this particular item. And what IRAS is saying is that, okay, if you have digital taxes, we look at it and see whether this is going to be considered a turnover tax. Now, if it's a turnover tax, you can take a deduction of that amount. But if this is not a turnover tax, but rather a tax on income, based on the current set of rules, you can't get a deduction. And IRAS said, going forward, you still cannot get a deduction. So in terms of the turnover tax, IRAS gave some example, like UK's digital services tax, that will be tax deductible, or India's equalization levy, if you are charged, that will be tax deductible. Right, so the next one, I will look at the new section 33A. Next slide, please. Right, section 33 is our general anti-avoidance section. So under the current section 33, if you enter into an arrangement to which IRAS takes a view that is a tax avoidance, so what they can do is they come in and disregard that arrangement and make the adjustments. So you just come in and basically say that, okay, if one of the main purpose is for entering in this arrangement is tax avoidance, then they actually can come in and disregard it, and you have no bona fide commercial reasons. So basically what you need to tell them, your gain or whatever advantage is, by the way, you have good, valid, bona fide commercial reasons to enter into that arrangement. If not, then section 33 will come in to disregard it. Now, before the enactment of 33A, you can just say, oh, okay, disregarded, no skin off your nose. So it's like, if you don't try, you're not sure whether you're going to get it, but you try, and then IRAS disregard it, you pay your tax. But come YA 2023, it's not just the tax that you're going to pay. You have to pay an additional surcharge of 50% of the tax on that transaction if it has been disregarded, and then there's additional tax payable calculated on it. Then you will have to pay that surcharge, and it's effective. It's already enacted in the Act, but effective only from YA 2023, which means to say whatever transactions that you're going to put through in 2022, which is just next year, will come in. So that is something that you may want to take note of when you enter or make any arrangements or do any tax planning. Well, I'm not saying that tax planning is not possible, but it's just that you have to be mindful of the fact that the thin line between the two, and if you crossed it, there may be additional penalty. Right, so let me move on to the budget 2021 now. I'll look after the corporate tax bit, and then Jeremy will come in on GST. Now, I think all of you know corporate tax changes, none. Okay, no change in corporate tax rate, not unexpected, because we don't want to go into somebody's blacklist or gray list. No change in the partial tax exemption, also not unexpected, because in fact, it has just been reduced, so-called with effect from YA 2020. No corporate tax rebate. That was quite sad. I was hoping for some, and I was even hoping that they will give a cash grant, for loss-making companies, just to put cash back into the hands of companies so that they can actually, further develop or further grow in Singapore. But unfortunately, no for all this. And there's some, like David said at the start, not a lot of changes, some minor changes here. Can we have the next slide?
Sorry, Engmin, can I just chip in there? Sorry, guys, everybody, I forgot to mention at the beginning that we're having a Q&A session at the end. And so if you want to jot down your questions on the note, I see somebody has already put one down, but we will accumulate those questions and ask them to the extent we have time later on. So sorry, Engmin, back to you.
All right, okay. Yes, okay, I'll just continue from here. Now, the next 3 slides that you're going to see is very simple for me to prepare, because it's exactly similar to what was granted last year. It's just like, like this carry back relief is just been extended to YA 2021. So what it means in the past, you can only carry back 1 year, and the cap of 100,000 is the same. But now going forward, only for YA 2021, just like YA 2020, you can carry back, to the 3 immediate preceding year of assessment. Now, as to whether you want to do it or not, it's a balance that you need to basically do. So you need to calculate what's your effective tax rate, how difficult it is for you to do the claim. So you do the calculation. Last year, there is a corporate tax rebate. YA 2021, there isn't. So you have just to do your sum and check on that. Right, the next point, the next one is on accelerated capital allowances claim. Similarly, same as what happened last year. So here it is only of value if the assets don't qualify for 1 year. It's not the low value item. It is only if once you do it, you are actually making an irrevocable option to claim. And basically you're claiming like 75% in 1 year and then 25% in the next year. So again, it's just a timing difference because it's just like you claim a bit faster, a bit later. And whether you really want it or not, again, you need to do your own assessment to see whether you fully benefit from it. Because although our corporate tax rate is 17%, with partial tax exemption and corporate tax rebate in the past, your effective tax rate may be different. And also, do you want to claim it so that you can, carry the unabsorbed CA can be carried forward? You have to consider that, especially for a 10E company. If you can't carry forward the CA, you may not want to claim it. So the next slide is on R&R, which is similar. Last time you claim 1/3. Last time, as in prior to YA 2021, you claim 1/3, cap of 300,000 over 3 consecutive years applies. So this particular relaxation for this year may not help if you have already maxed it out last year. So YA 2021, if you think that you're going to do the 300 and claim it over 1 year, if you do another 300,000 this year, you can't claim. So it's not really very helpful. That was the feedback that we gave to the ministry. And the response that they gave to us is that these are actually targeting at the SMEs. So we don't expect them to incur a lot in terms of R&R expense. Okay, shall we move on to the next slide? Now, this one is on enhancement of double tax deduction on internationalization scheme. I would just want to highlight, the enhancement. Number one, approve virtual trade fairs. This is recognizing the change in term. You don't need to have a physical trade fair. If you have a virtual trade fair, get it approved, and then you can get, for every $1 of expense that you incur, you can get another $1. So this is the 200% deduction that you may get. And in terms of the qualifying expenses, used to be a fairly narrow sort of list. They have actually expanded it to include logistic costs. And also in terms of qualifying activities, it has also been expanded. I mean, for those of you who are familiar, there is a 150 limit, which you don't need approval. You can just do your double deduction. And anything above that, if you still want to claim, you need to seek the approval of the relevant authorities, whether it's Enterprise Singapore or Singapore Tourism Board. Right, the next one. Okay, now this is just a very specific change. It's just an enhancement to this investment allowance scheme, where it's been expanded to cover some projects, and the conditions, they make it a bit simpler, they streamlined it. Apart from that, there are not much changes here. Okay, the next one. Now, okay, this particular slide are all the remaining changes that we have. I think the key ones that I would like to highlight is the 250% tax deduction. So you can continue to donate, and for every $1 of donations that you make to IPC, you get 250% deduction. So that one, they have sort of like extended to 2023. And then for companies, the BIP scheme, the Business and IPC Partnership Scheme, also extended to 31st December 2023. So they wanted, more people to support the corporate volunteering program. And just for interest, the not-for-profit organization tax incentive extended. And then the last point is on ASP. Now, the ASP scheme has got many different components, including those where they actually extend some loans at some preferential rate. Now, this one will lapse. The only one that remain in the ASP scheme would be the 100% investment allowance. When this was introduced, they said it wasn't to replace PIC, but it's similar to a certain extent, except that, of course, for every $1 of your of the support, of the investment you make, you get another $1 in terms of deduction only, right? So I'll just cover off personal tax because it's just basically no change. Okay, no tax rate or no tax rebate. Unfortunately, was hoping for it. At least all of us would be paying taxes. Yeah. So, but nothing. But just a reminder for individuals, if you're working from home, you technically can claim your utility bills, your telecommunication bills against your income. IRS has actually come out to say you can. Now, the only thing you need to do is you can only claim incremental costs, which means to say you must be able to show them, before I work from home, my utility bills is 100. After I work from home, it's 200. Then I can only claim that incremental cost of 100. Now, if there are 5 people working from home, then you have to divide the 100 by 5. Each one of you will have to claim that $20. So that's how it works. And some people have been given allowances to work from home. Now, if you're given allowances to work from home, that allowance is a taxable allowance. Okay, now with this, I'll hand over to Jeremy to walk through the GST changes.
Good morning, everyone. Thank you very much, Heng-Ming. For those that haven't heard me present before, I do have a stammer, so if I do get stuck, please bear with me. And a new year brings a new budget, and whilst there were very little changes from a direct tax perspective, the same is not true from a GST perspective. And there are a couple of key takeaways that I'd like to focus on over the next few slides. To begin with, Deputy PM Hem continued his consistent message that the GST hike is a nasty necessity, and in order for the country to meet its social and welfare spending requirements in the years to come. And whilst he said that the hike would be sooner rather than later, it must also be subject to the economic outlook. And he reconfirmed that it will not take place during 2021 and will happen within 2022 at the earliest. And further to that, we still don't have any insight as to how the increase will actually be implemented, whether it'll be a staggered increase, so a rise from 7 to 8% and then from 8% to 9%, or whether it'll be a straight 2% hike to 9%. So that sort of just covers off the reminders that he made. I'll now go into the changes that were proposed. The main trigger for the first three proposed changes are effectively a continuance of the message within Budget 2018, which was the Ministry of Finance is looking further at how it can level the playing field between the overseas companies and the domestic companies. And this is very much in line with the first BEPS action plan, which originally came back, which originally got published back in 2015, and is to ensure that Singapore's GST regime is in line with other GST and VAT regimes around the world. And then the last change is subject to the industry consultation. The Ministry of Finance has decided to amend the zero rating conditions for media and advertising related services. And on the next couple of slides, I will go into each of these changes in a bit more detail. And so to begin with, as I mentioned, the trigger for this change was to further level the playing field between the overseas and the local companies. And the current change is around the provision of non-digital services from non-resident suppliers to consumers within Singapore. So the current position is that the overseas vendor registration regime is only applicable to digital services which are supplied to consumers within Singapore, and that came into effect on the 1st of January 2020. So what has been proposed is that from the 1st of January 2023, the regime will be expanded to not just relate to digital services, but will also include non-digital services. So that may be things like the live education, the fitness training, counselling, as well as a few other non-digital services. So we'll get to a position where all services provided by non-resident companies but supplied to private consumers here in Singapore will be subject to GST under the overseas vendor registration, with the exception or on-the-spot consumption services, which can be things like any concerts and hand exhibitions. And similar to the current position under the overseas vendor registration, it's likely that any overseas suppliers which are selling through an electronic marketplace the electronic marketplace will be treated as the supplier of the services to the consumer, and the GST reporting obligations will fall on the marketplace rather than the overseas supplier. Casey, can we swap to the next one, please? The second change, which again is still looking at suppliers from non-resident companies to non-GST registered businesses here in Singapore, as well as private consumers, is in relation to the supply of low value goods. So the current position is that any goods which are ordered via the internet and then delivered via air or via post are not subject to GST on importation, provided the value is less than $400. So what the proposed changes, which are again due to take effect from the 1st of January 2023, is effectively to change consumer spending behaviors, because historically a lot of consumers were splitting orders that they were buying from overseas suppliers, so that the value was below $400 at the point of importation, therefore avoiding the import GST charge. So to address that gap, the OVR is also proposed to be extended to cover the taxation of such low value goods. So again, that could be consumable goods which have been bought via Lazada, Taobao or Shopee and all such equivalents. And again, much like the change on the previous slide, when a consumer is buying the goods through an electronic marketplace, the marketplace will again be the one responsible for the GST reporting and charging obligations to the Singapore consumer. And then we'll keep on the theme of the low value goods. However, this particular slide is looking at a scenario where a non-resident business is selling to a GST registered business here in Singapore, and the goods are again coming through via air or via post. So the current position is, again, when the goods are coming via air or post, they're not subject to import GST, provided the customs value is less than $400. However, from the 1st of January 2023, the reverse charge regime, which was implemented on the 1st of January 2020, will be extended to also cover purchases of low value goods from non-resident businesses. So the onus will be on the GST registered business here within Singapore to self-account for the GST on the value of the low value goods on its GST return, and then treat that deemed output tax as input tax and subject that to its normal GST recovery percentage. And much in the similar way of the existing reverse charge scheme, the reverse charge will only apply to GST registered businesses that are not entitled to full input tax credit on their purchases. So it will effectively only cover the partially exempt businesses such as the banks, the financial institutions, and the residential property developers and property holding companies. So what we have in effect from the previous 3 slides is we have the tax base within Singapore has been expanded to encompass new types of transactions, meaning we're effectively going to increase the GST revenue without directly increasing the rate of GST. And the last change that I'd like to touch on is a bit more specific, as it effectively only applies to media and advertising related sales. So following an industry consultation, the Ministry of Finance has made the decision to amend the conditions for Singapore companies to treat their media and advertising related supplies as qualifying for 0% GST. So the existing treatment has always been around where's the intended location or place of circulation for the media and advertising related content. If more than 51% of that was bound for a country outside of Singapore, then it would be entitled to 0% GST. Whereas if it was substantially circulated within the Singapore market, then it would be subject to the standard rate of GST. And what they've effectively proposed is that the new treatment will effectively revert to the more general provision for zero rating, which is looking at, well, where is the customer and the direct beneficiary of the service belong? And if they belong in a country outside of Singapore, then they will qualify for 0 rating. However, if they belong here within Singapore, then the 0 rating conditions are not met, and a business will be required to charge the standard rate of GST. And with that, I've completed the GST changes, and I will hand back over to David to take us through the Beyond Budget 2021 section.
Okay, thank you, Jeremy, for that. I actually did have a question for you, but I'm told that as a panelist I can't actually ask them, so we'll maybe get to that at the end. So let's take a look at what we're going to have a chat about now, which I had thought had been a slide giving us a rundown of what we were going to talk about, but we'd actually looked at that slide earlier on. But the general overview looking forward for Singapore is that it goes without saying that COVID-19, or rather the reaction to COVID-19, has had a devastating effect globally, the extent of which we can't even fathom at the moment. My view is that there is going to be a great deal of carnage that comes out of this when the mists clear and we see what's actually been going on. But certainly what we've also seen during 2020 is that we have learned new skills, we've learned new ways of working, we've learned new attitudes, and some of those genies are not going back into the bottle. They're here with us to stay. And in fact, maybe some of the COVID measures are going to be here to stay as well. But that's not what we're here to talk about. And so at the moment, I think there's a perfect storm of challenges for Singapore. There's been a lot of stuff brewing for a long time, but the COVID-19 reaction has accelerated a lot of those issues and looks like it could be bringing them to a head in the not too distant future. And so I've broken down the threats to Singapore as being, on 2 foots. One, external threats, which are things that we really can only sit by and watch and are beyond our control. And then internal threats, which we have some control over. But Casey, if we go back to the previous slide, so I'll just go through those. We've seen protectionism, obviously, MAGA, Fortress Europe, China, everyone pulling in their horns, putting up their defences. That isn't going to go away, and it is something that Singapore is going to have to live with and deal with. We're also, as Munjal will tell you in a minute, going to see tax authorities that are hungry for tax revenues. The OECD has very kindly armed them with all the tools and information that they need to be able to wage those wars. So watch out on the international front as far as that's concerned. Foreign direct investment competition is going to heat up, because everyone knows that you've got to grow your economy in order to grow your tax revenues, in order to put food on the table for your country. And then, as I hinted at earlier, foreign talent, talent in general, there's going to be a massive tug of war for that, and Singapore is not necessarily as well placed as it once was for attracting that talent. And part of that piece is around geography. Singapore's geography is something absolutely beyond its control. We can't tug it off on a rope into the South China Sea anywhere. It is where it is, and we've seen things happening for a number of years. For example, we've got the oil pipeline that is now going straight through Myanmar into China. Something that people haven't talked about for a long time, the Northwest Passage, which can get ships, if it unfreezes, and I don't know if it has unfrozen yet, but can get ships from Amsterdam to Tokyo 7 days quicker than if they come round via Singapore. We got other initiatives that have been left on the shelf, the land bridge in Malaysia, Thailand, etc. Those are things that are sort of going on in the background. But one of the other challenges to Singapore's geography is that it was a place for people who had regional jobs to come and base themselves because of the infrastructure, the education, the safety, etc., etc. Great place to live, great base from which to operate in the region. As we've now seen, people coming here for travel and adventure have been locked in their rooms for a year. That isn't happening, but during that time they've learned new skills. They've learned that they can be elsewhere and do their jobs elsewhere. We've had clients coming to us and saying, hey, our CEO wants to go back and live and work in Australia as our CEO. What should we say about that? Obviously, there are tax issues around that, but that sort of thing is going to become more and more common, where people are saying, well, why do I need to be in Singapore when I can be at home sitting on my hacienda looking out over the rolling plains rather than being in Singapore? Casey, next slide. The internal threats, which are things we do have control over. Demographics, massive elephant in the room, never seems to get talked about. We'll take a quick look at that. Singaporeans' love affair with real estate. I will hopefully demonstrate that that's something that needs to be slightly re-looked at. Funding and finding entrepreneurs. How are we going to do that? This is the core engine room of growth for Singapore going forward. And then the future of the workplace, which Adrian is going to talk about, is a threat, as I mentioned, maybe on a geographical basis to Singapore, which it maybe can and can't have some control over. And then the last piece is where we go with indirect taxes. So we've been through that. So real estate and the love affair. The big issue with certainly residential property in Singapore is that it is simply not a productive asset. You build it and it sits there, and if there's no one living in it, then it just continues to sit there. And I don't know about the rest of you, but certainly looking around Singapore, I found it quite alarming at the number of complete tower blocks of residential properties that are obviously sitting empty. It's not a case that they've all got great curtains, right? There are no lights on in entire residential property blocks in Singapore and all over the place. So to me, that smacks of being, you know, inefficient, almost criminal at the end of the day. High property prices, everyone goes, ooh, my house is worth, you know, 10 million bucks. Well, that's fantastic. But if it's the only house you've got and you need it to live in, it could be worth $1 billion or it could be worth $10. The question is, can you afford to pay for it? Can you afford the mortgage? And if you think that is good and you've got a dream house next door, you're never going to move to the dream house next door if it is also worth extortionate amounts, because you're never going to be able to afford that step up. High property prices are not good for first-time buyers. Effectively, it's a market that is holding itself up by its bootstraps. It's money going round in a circle and effectively not producing anything. What it also does is, because I think it's almost an automatic reaction, is that as soon as you got some spare money in Singapore, you invest it either in the stock market, which is another matter, or you stick it in some property in Singapore, and that makes you feel good. But that money, if it's just sitting there, is doing nothing for the country. It's doing nothing for tax revenues, etc., etc. And high property prices also makes Singapore uncompetitive, because it makes the cost of living higher, which pushes up the cost of wages, which pushes up the cost of everything that you do. Casey. So a couple of thoughts around how we monetize this asset. Effectively, as I hinted earlier, lots of empty places, probably owned by non-residents, as an alternative to sticking money in a Singapore bank account where it is equally safe. Lots of foreign money coming into Singapore, and parking in Singapore's extravagant parking lot, which is also putting the prices up for everybody else. So my view is that there should be a parking fee for that privilege. One of the things we could think about is higher property taxes for non-resident owners. I know we've got a scaled one for owner-occupied and unoccupied properties within Singapore as it stands. I would be proposing something that puts a bit more of a sting in the tail for non-residents who just who own properties, but an even higher one if they just pay for the property and leave it empty. The other thing is, or the other thought could be, if some of you are old enough to remember, back in the day, properties that used to be your second property but were either left unoccupied, or you put grandma in there at a reduced commercial rent, or, you know, a peppercorn rent, there was an imputed rental income as if you had rented it out based on the annual value of the property. That, I see, is something that should perhaps be reconsidered for properties that are being left empty. And that can be in conjunction with the higher property taxes, or it can be as an alternative to it. But some way or another, we've got to think about how we monetize that very valuable real estate asset that is just sitting there. And of course, part of this plays into the maybe hidden, I wouldn't say hidden agenda, but that thing going on in the background of that people talk about, taxing wealth taxes. You know, are we going to bring back inheritance tax, etc., etc.? Well, this could be an alternative, and you can't tell me that if you own 2 properties in Singapore, you aren't sort of slightly well off. And so possibly some of these things could be a way of getting some taxes back into circulation. Looking at a capital gains tax for only investment properties, As in the UK, you pay CGT on all your properties except for your principal private residence, i.e. the place that you stay. I know, unpopular, I know Engmin and I have flagrant rows about this, but I'm only expressing my thoughts on it. And then, of course, the one that is probably really controversial is the use of CPF for property purchases. Two things. Singapore's heading towards a asset-rich, cash-poor retirement, and taking your money out, taking your CPF cash out for properties is, just reinforcing that outcome. But by putting more money into circulation for that purpose, all it does is it increases those property prices, and so the thing spirals on forever and ever. So these are just a couple of radical ways that we can maybe think about real estate. As I mentioned, it satisfies the belief that wealth should be taxed. And the other thing that I mentioned, putting money in residential real estate doesn't produce anything. Why don't we find some ways of putting it into businesses that do use those funds productively? And then the big elephant in the room, we hear the government talk a lot about medical care and how we're going to fund that, and the GST hike was part of that. What we don't hear about is what you do if you're healthy and you're not in hospital all the time. How are you going to get by when you retire? And just to put this into context, between 1955, when I was a boy, and today, the life expectancy in females has gone from 63 to 86, and from males 58 to 82. Come on, boys, I'd like to see you put in a bit of an effort. Can we get it to 83, 84 at least? Show some competition. But the point is that in 1955, you weren't even expected to reach retirement age. It was, the end of the road as far as you were concerned. Your job ended, you ended, see you later. Now you can expect to live for another 20 to 24 years beyond what is now the minimum retirement age of 62. That in a 40-year career is having to live for half of that career again without any money, basically, or without any salary or income coming in. Globally, and I suppose this is now a pipe dream, but retiring on 2/3 of your last drawn salary, used to allow you to maintain your standard of living. And ultimately, that's what people are after. They don't want to go nice standard of living, retire, poverty level. Of course not. So we have to have ways of being able to keep our standards going. And who's going to pay for that? Well, the generational pyramid has been turned on its head, whereas you used to have 8 children, and if you were lucky, grandma, a couple of parents. Now you've got 8 great-grandparents, 4 grandparents, 2 parents at least, and one little chap who's got to pay for all of this. It's been turned upside down. Obviously, something has got to give in the face of those demographic changes. The CPF, if you do your maths, will only provide subsistence. It's not enough. If you look at it, and I did a little calculation, you can do this on the website. If you've got retirement account savings of 553,000 at 65, and don't forget this is cash, this doesn't include what you've put out into your house, so you're going to have free cash, will pay you $3,000 a month for admittedly the rest of your life. But in 10 years time, that $3,000 is going to be worth 1,500, and in 20 years time, it's going to be worth about 500 a month in real terms. So, if you think you can get by on that, well done. What can we do with this? Supplementary retirement schemes been around for a long time, but if you look at it, I think it's fairly stagnant. People just seem to have parked their money in there for the sake of the tax deductions, which I presume now they've spent, which means that when the money comes out the other end, you get taxed on half of it. It's noted to be expensive because of the transaction costs, etc., and the maintenance costs, and the investments you can invest in are limited. So, you know, SRS isn't moving any dials. The best thing that can be done with that is to put it on a footing with CPF and exempt payouts from tax, which, if again, those of you can remember, in 1993, retirement payouts used to all be tax exempt. And then along came some Charlie who put $1 million of tax deductible contributions into his pension scheme, and the next day after he'd retired took it out tax-free. Obviously, you're always going to get people gaming the system, but that's not a reason for dismantling the system entirely if you put in safeguards around that. So more of that needs to be thought about, Casey. And then we've got the other little thing that's been around for a long time, Section 5 schemes, which do give you tax deductions for contributions, and the good thing about them is that they actually try to pace your rates of contribution with your standard of living and your expected final salary, etc., etc. Even though it doesn't come anywhere near the 2/3, at least when you add that to your CPF, you're edging your way closer there. So this is something that has been around for a long time, but it got a circular on it a little while ago, but that had no impact on, as far as I could see, freshening the whole thing up, which I think would be a lovely thing to do. It's also good for expats because part of the estimation of the benefits takes a deduction for total employer CPF contributions, and of course expats aren't paying into the CPF, and therefore there wouldn't be that deduction. So expatriates can actually put more into one of these schemes in a tax deductible fashion, and get an advantage or claw back some of the disadvantage of not being able to contribute to the CPF. But the problem is, again, payouts are fully taxable. Let's go back to pre-1993, Casey. So a number of ways of improving it. Not going to bore you with all the details, but the things that I've listed there are effectively the missing pieces in how the current schemes operate. It needs to be broadened, it needs to be made more flexible, and also allow fund managers into the game, because having a thriving pensions industry in Singapore is great news for fund managers, because that's what they do. They manage these things, and because there aren't really any lying around, that piece of the market doesn't exist as far as they're concerned. Also, pooling these things allows economies of scale, properly professionally managed funds at a reasonable price, and then again, exempt retirement payouts. The other thing is, why not open CPF to expatriates? Because at the end of the day, it does encourage a commitment to Singapore. When I first arrived in Singapore in 1991, on an employment pass, I paid into the CPF. Lovely, very nice. It's a great thing to have. I mean, I was probably knocking it a bit earlier on, but it's certainly better than not having it by a long stretch. And what Singapore's got to do demographically going forward is produce more people that are committed to Singapore, Casey. A couple of other things, re-examining the SRS, see if it really is any use. I get the impression it's just been left lying around, so give that a good shaking. And as I mentioned, let's get some real retirement funds together and give a boost to the fund management industry as well. So entrepreneurs, our little engine room, and I'm running slightly short on time, but let's give this a whip through. Some fantastic initiatives are being put into Singapore startups. Startup SG Singapore provides a fantastic platform for an ecosystem for funding, marketing, networking amongst all these startups. Primarily, though, in the tech industry. I think you'll find that if you're just trying to set up something sort of steam driven, bricks and mortar, doesn't sort of cut it. However, it's better than nothing. We've seen other initiatives as well. Venture capital fund management, fast track license from the MAS, but then that has got quite a lot of rules and regulations around it, which means it's not terribly extensive, but again, better than nothing. And then the good old Section 13H venture capital incentive was dusted down. The most interesting thing about this is not so much the incentive for the fund itself and the tax exemptions that the fund get, but also it's a fantastic deal for the fund manager, because that other elephant in the room, carried interest, gets exemption. But that's probably something for a completely different seminar. But complementing all of this, we had the angel investor scheme, but that was binned last year. Why? Well, we were told that it had been superseded by all these lovely initiatives by Startup SG, and that could be one reason. But typically, incentives are withdrawn because they have failed to meet their original objective, and there's been a lack of interest in the thing. So let's just have a look on the next slide at what that could have been. Possible reasons for the failure of the angel investor scheme was that it only applied to individuals with significant taxable income. That is restricted really to just me and Eng Min and a couple of doctors and nurses and stuff like that. And these people have got day jobs. So one of the things that was required was, like a track record of investment, almost investment management, startup, industry, etc., etc. Well, of course, these people have got the money, but they can't provide the expertise. And then the people that eventually can provide the expertise will have retired from those professions, but they'll be earning mainly exempt income, so they don't need all the lovely tax deductions that the scheme gave. On top of that, a very complex set of rules and regulations. Not surprised that it didn't get anywhere. Casey. So what I would propose is, let's bring it back and fix a couple of things and really give another boost to the funding of entrepreneurs in Singapore. And that means not just tech entrepreneurs, but entrepreneurs across the board. Anyone that is starting up a new business, employing people and generating eventually taxable income. Instead of it being applicable only to individuals, allow companies to come in and get tax deductions from it. So they're a much better target. Take the lid off the amount of the tax deduction. The tax deduction that angel investors used to get was 50% of a maximum of $500,000. Allow carry forward of excess investments, i.e. allow your deductions to be carried forward as if they were trading losses, rather than at the moment they're just lost and they're completely wasted. And then the most alarming thing about the scheme was that if you backed a winner and then you sold it, you're still back in the old capital versus revenue argument. Is it a taxable gain? Is it not? For goodness sake, can we not bury this one for once and say, you've backed a winner, well done, you're going to be exempt when you dispose of it. So thank you for your contribution to Singapore. So a whole host of other things around there. I think the angel investor scheme didn't work because of complexities and being restricted to too narrow an audience. I think it could be brought back with good effect. Now, I think, Casey, that's the end of it, is it? And we hand over to Adrian, who's going to tell us all about WFH.
Thanks, David, and a little bit alarming about your comments on the demographic. It sounds like I'm going to be working for at least 20, 30 years, and obviously this future of workplace is quite important.
I would hope so, and hopefully there's still taxation around to talk about.
Yeah, and a workplace.
And a workplace, yeah, exactly.
So just a bit of background before I go into the slide. Obviously, over the last 12 months, we've had a lot of travel disruptions, which has had a significant impact on our clients. Remote working, not just working from home, but remote working from other locations, has arisen as a result of this disruption. And so we've been working with clients to examine, permanent establishment risks from people working overseas, and subsequently, or in conjunction with, what the employer and employee obligations are as a result of that. It's thankful that many countries have relaxed some of these rules, if you can fit into them. So it's almost as if they were working from Singapore or wherever they were employed. But as travel restrictions lift, obviously these relaxation of rules will continue to be phased out. We've also seen other things come up more frequently, like remote assignments, dual contracts, and I suspect they aren't going anywhere anytime soon. So clearly, since the circuit breaker happened globally, it has led to the largest working from home experiment globally. And obviously a large forced take-up, I guess, of flexible working. So even now, as things have relaxed, 3 of the 5 presenters are at home, and 5 of the 5 presenters wish they were presenting from overseas, which could be a reality in the future. And this really echoes what Mr. Heng said during his budget speech. He mentioned that working from home is just a short step from working from anywhere. And some firms have already started to implement and move towards this. So we've seen tech firms move towards working from home. Facebook earlier on said that they were going to pay people based on where they're working from. Not necessarily Singapore, because you live and work in Jurong versus you live and work in Novena, you're still going to get paid probably the same amount. And Spotify over the last few days announced that they're going to allow any one of their employees to work anywhere. So it's a real shift that's already happening. So what is the impact of this shift, and what do employers and I guess Singaporeans and employees generally have to consider as a result of this globalization of the talent pool and even the government? One thing is, do you need a property like this? I'm currently in the office. It's currently underused for obvious reasons. And what does that property look like? And then for David, Eamon and Munjil who are working from home, are you going to support those employees with screens, chairs, ergonomic tables, and how will that look? And actually, do you even know where they are? For all I know, Eamon is actually sat in, I think she wanted to be in Bintan. She didn't really push that one very far. But if she's in Bintan or even Malaysia, do I know that? And how much of her time is spent there? And if she's over there, have I analysed the P risk? Do I need to worry about tax clearance if it's an expat? Do I need to worry about immigration? Do I need to worry about the employer withholding obligations in those countries? And picking up on one of David's comments, if your CEO is the person who wants to move, you don't want him to be in a newspaper for incorrect filings, because that will have a bad reputational risk for your firm. So all of these things are going to make the HR role and the tax role a lot more complicated when dealing with your employees. But I don't necessarily see it all being work from home 100%. Clearly, well, maybe not clearly, but I'm in the office today and have been on and off in the office as needed. And I've certainly seen it's reminded me that actually FaceTime with your colleagues, with clients, with intermediaries is really important to build relationships for training and when you're working team projects. So although we've worked very well working from home and working remotely with the travel restrictions, once the travel restrictions lift, I do see an increase in the global mobility of people and back to relatively normal levels. Maybe not be exactly the same as before, but they'll be pretty normal levels. When that will happen, I actually don't know, but I guess we'll see as that turns up. And I guess that therein lies one of David's comments earlier. How will Singapore fare when all this global mobility picks up again? A lot of people came to Singapore because of the ease of travel. If travel remains restricted going forwards, then that may taint Singapore's opportunity to attract that talent into Singapore. So how does the government look at and address those? And the other thing I wanted to touch on, and this will effectively lead into the slides, is that in one of our articles recently, Coining in of Foreign Talent, I noted from a personal perspective that I've been here for 5.5 years, and I've seen an increase in protectionism when it comes to foreign talent. And this budget, as David suggested, has kind of further enhanced that. It's nothing new globally. We've seen it UK, US, and other places, but I want to urge the government caution when they're trying to increase that protectionism. Completely understood that they have an obligation and a need to protect Singaporeans and their jobs, but I'm going to make some points to argue that maybe there is some other thoughts that they need to bring into the plate. So the first one on the slide is, Singaporeans can work abroad, and not just that, they can work for foreign employers from Singapore, and they can compete for those jobs from overseas companies. So should the government be looking at ways to encourage overseas employers hiring Singaporeans in Singapore without necessarily setting up an entity here? Clearly, if they don't do that, there is a PE risk, a permanent establishment risk in Singapore, and even potential CPF obligations for the overseas employer, which they may or may not be aware of. The other thing that the Singapore government can consider is, how does it encourage either the employee to send Singaporeans overseas, or even the employee themselves to go overseas to find work, build experiences, build their talents, their skill set, and then come back to Singapore to bring that newfound talent in Singapore to train the next generation of Singaporeans. The second point, the second sub-bullet point there is, I talked about the global talent pool, and working from home. I don't need to be in Singapore to do a Singapore role, potentially. And so if we're trying to restrict foreign talent from coming in, actually, is that the right thing? Is a Singaporean in Singapore, or even myself in Singapore, am I competing for a job against someone else who's looking to come to Singapore, or am I just competing on a global level against someone sitting in the UK, someone sitting in Afghanistan, or wherever they want to be sitting? And actually, should the government be trying more to encourage entrepreneurs and talent with technical expertise to help build the local talent pool? It was good to see the government do some focus on upskilling Singaporeans, but I would say, a lot of what I've learned is on-the-job training, and having foreign talent when I was in the UK come to the UK to train me built my knowledge pool, and I think that's what the government needs to do more of in Singapore, or consider to do more of in Singapore. And the final point I wanted to make is really, if we don't allow or restrict foreign talent from coming to Singapore, they will set up businesses and take talent with them overseas. And if Singapore, having spent 100 billion plus going forwards on, protecting Singaporeans' jobs, protecting the economy in Singapore, how are they going to generate the revenues and tax revenues to fund those if people aren't coming to Singapore to create jobs, to create spending in Singapore? So just some food for thoughts. I know we're running slightly over time, so I will now pass over to, I believe, Manjul. Casey?
Yeah, thanks, Adrian. Thanks so much. Yeah, I'm going to sort of discuss on what are the potential transfer pricing implications that we could see in the Singapore tax laws in the next few years to come. But before I get into that, let's just sort of take a step back so that you can get some perspective on this. So the last year we saw that most countries across the world were sort of ravaged by COVID. You had businesses that were sort of being impacted adversely. You had people losing jobs or taking huge pay cuts. And it was quite a difficult situation for businesses as well as citizens all across. Because of this, you had a huge amount of government assistance provided to businesses as well as to individuals through sort of financial stimulus and cash transfers. And this was required at that point of time for ensuring that businesses and individuals are able to sustain on account of business slowdown, on account of COVID. Now, a lot of these governments, for providing these financial packages, had to sort of borrow significant sums of money. This has led to a adverse public debt to GDP ratios for these countries, and at the end of the day, they still need to sort of make these to repay the monies that they've borrowed to put out these financial packages. And the question then is that how will they sort of go about raising monies to repay these debts? Now, in a very traditional sense, usually governments used to sort of use taxation as an avenue to repay these loans. Very often this would involve raising the existing tax rates for income tax, for personal tax, or for GST, or they would sort of come up with a new tax legislation, something new to ensure that they can raise taxes, they can raise monies through taxation, through the taxation route. But in the present circumstances, this really may not be possible because in any case, a lot of the businesses are suffering losses, etc. So just raising taxes is not really going to meet the purpose. Again, governments are looking at a huge amount of investment into their countries in order to sort of give impetus to the economy, and raising of taxation or introducing new regimes would be a deterrent. So taxation really may not be the way to go to raise monies. So what else can they do? A potential tool or a potential mechanism that's available with governments is the use of transfer pricing mechanisms. Now, a lot of countries in developing nations as well as developed countries already have a transfer pricing regime or a transfer pricing regulation in place. So the transfer pricing tool can be an easy way to sort of raise money by governments. One, the transfer pricing mechanisms are already in place. What transfer pricing does is that it sort of attributes an MNC's revenues and profits within the various jurisdictions in which they trade. So this does not really involve coming up with a new tax regime or raising taxes as such. It only means coming up with a manner and a technique to sort of get a larger pie of a larger piece of the existing pie. Secondly, transfer pricing in itself is a pretty gray area where one person's perception or one person's opinion on what constitutes the arm's length price may totally differ from someone else's. And hence transfer pricing then can be sort of interpreted in a manner which is favorable to a particular jurisdiction to try and get a larger piece of the MNC's revenues. Lastly, transfer pricing, the transfer pricing adjustments are usually done are usually made on a transactional on an MNC's transaction per se, rather than the profit or capital. The transactions between intercompanies can actually go into many a million, and a small percentage adjustment on a purchase or an intercompany sales transaction would lead to a huge amount of adjustment in absolute terms, and then the consequential penalties and interest as well. So with that in mind, transfer pricing can be an effective tool to sort of raise monies, as we just saw. Now, looking at this from Singapore's perspective, we'll note that some of Singapore's key trading partners have had pretty aggressive transfer pricing regimes which have been in place for a long period of time. Some of these countries have further strengthened their transfer pricing regulations over the last few years by putting in place significant measures. These include introducing the BEPS action plans into their regulations. And I think the minister had sort of alluded to this in his budget speech as well. You got countries sort of having a transfer pricing cell, which are sort of designed to concentrate on transfer pricing issues during the course of a tax audit. You got countries coming up with specified risk-based transfer pricing audit mechanisms, which will sort of look at transfer pricing in a focused manner. And you got certain countries that have sort of pre-identified certain issues or certain industries which they will sort of concentrate on vis-a-vis their transfer pricing audits. Now, compared to this, if you look at Singapore, the present Singapore transfer pricing regulations are extremely taxpayer friendly and are rather pragmatic as such. And hence, they don't really compare with the aggressive regimes that some of our key trading partners already have in place. The consequence of this could be that an MNC who's already facing business difficulties, who's sort of just trying to sort of come out of a business slowdown, etc., is in a process to sort of buy peace. They really want to try and avoid sort of conflicts, or at least on the transfer pricing front, and hence will tend to take a more conservative position in jurisdictions that have extremely aggressive transfer pricing regimes, and hence will try to transfer price out from Singapore into these aggressive transfer pricing jurisdictions. This will have the consequence of Singapore's tax base being eroded to a large extent. Yeah. With that in mind, it is possible that we will sort of see in the years to come the Singapore IRAS and the Singapore government strengthening their transfer pricing regulations to ensure that the tax base is not eroded and Singapore is able to sort of get a fair share of its transfer pricing revenues from the business and operations of the MNC. And some of these, some of the sort of steps that we may see in the sort of near future could involve, one, introduction of some of the BEPS action plans into the Singapore tax laws. You could have the Singapore government coming, relaxing or doing away with some of the exemptions that presently are in place vis-a-vis the transfer pricing documentation requirements. You could have the Singapore government enhancing the penalty provisions on transfer pricing adjustments as well as the non-maintenance of documentation, because the present penalty limits are pretty much the lowest across jurisdictions. And you could probably have a focused approach on transfer pricing audits. So these are some of the thoughts, these are some of the sort of transfer pricing developments that we can expect to see in the years to come. However, as the minister sort of really affirmed during the budget speech, a lot of this will largely be dependent upon what's going on in the rest of the world, as well as looking at the business climate and the entrepreneurial climate in Singapore at that point of time. So it's going to be on a very informed basis rather than a pretty knee-jerk reaction, and that's something that's really hearty to note. So that was my take on transfer pricing, crystal ball gazing for Singapore. I hand the mic over to Jeremy to sort of take us through the GST.
Thank you, Panjal. I appreciate we're running a bit short on time, so I'll try and cover these as quickly as possible. And just a reminder that we will be sending out the slides after the presentation, so you're more than welcome to go through them in a little bit more detail. And whilst I covered the policy and the theoretical aspects of the 2023 changes earlier on, as with all things tax related, ultimately the devil is in the detail. And we're in a position at the moment where the Ministry of Finance has only announced the proposed changes in relation to the reverse charge for local GST registered businesses, and they have stated that they will be going through an industry consultation prior to finalising the finer details around the regime. And this is, but nevertheless, as we've all learned from previous experience, most recently in relation to the 1st of January 2020 changes, the key for a successful transition and implementation is starting as early as possible. And that also goes for the GST hike, the GST 2% hike as well. Businesses should actually start considering and reviewing any long-term customer contracts to ensure they're adequate, that they are protected against any hike in the rate of GST. In other words, they're able to charge that additional 2% on to their customer. And then just in relation to the next slide, for the overseas businesses, again, we covered the theoretical aspects of the change, and we're still awaiting the finer details of the regime. But this is definitely something that should be on the tip of the tongue for your businesses within the e-commerce sector. And it's appreciated that obviously a lot of these non-resident businesses have already got the systems in place to cater for similar GST or VAT regimes within the other jurisdictions, such as the European Union and the UK, Australia and New Zealand, just to name a few. However, they will still require some customization from a Singapore perspective, and to that effect, we would be looking to run a separate session to cover those changes from a Singapore perspective, once we have received the finer details around the regime. And I guess with that, I'd just like to hand back over to Ming to potentially lead through a short section on Q&A, if there are any pressing questions that we'd like to address.
Thank you, Jeremy. Apology, we have overshot the time, but we will just try and take a couple of questions very quickly. I think the first questions I have is that, is the 50% tax surcharge deductible for corporate tax purposes? I would delegate it upwards. David has said that he will answer this. David, what's your take on this?
Well, if you look at any taxes, there's a specific prohibition over the deductibility of anything that purports to be a tax. And I couldn't see the point in them. I suppose it's called a penalty, isn't it?
Yeah, I think it's punitive. I personally think that you can't take a deduction on it.
So typically a penalty is just a penalty, end of story. Not deductible. I'd be extremely surprised if it was deductible. That's
right.
Yeah.
Okay. The second question is, are schemes like IAEE, investment allowance, and energy efficient equipments, and the automation support package available to subsidiaries of MNCs operating in Singapore? I'll take this question. Now, the IAEE one, I think it doesn't really matter whether you're SME or not, because it's really to encourage, use of energy efficient equipment. Whereas the ASP, I would say I don't know the answer, because previously ASP, there are three components. The investment allowance is just one of it. And from what I've looked at before, some of them require you to be an SME, and some of them also require you to have a 30% Singapore ownership, Singapore, based citizens ownership. So that one, I think we have to wait for more details to see whether the ASP package, as the revised one with just the investment allowance, would cover MNCs operating in Singapore or not. Okay, the third question that I have is on GST. Now, the cost of, so the question reads this way: do you think the cost of collection for the GST changes will outweigh the amount collected?
Yeah, sure. I can take that one. So I guess the answer would be similar to the changes that were announced in the budget 2018, which came into effect from the 1st of Jan 2020, especially in around the overseas vendor regime. The use of appointing the online marketplaces to effectively be the supplier and then liable for the GST reporting obligations means that the Singapore Tax Authority only has to manage and administer a small number of taxable persons, but it still gets the substantial amount of the tax revenue, because the electronic marketplace effectively would act as the aggregator. So there'll be one taxable person, however, there'll be hundreds or thousands, if not tens of thousands of overseas companies selling through that marketplace. So it effectively has the economies of scale around that by having a small number of taxpayers generating the most amount of tax revenue. So I do not foresee that the cost of administration would significantly grow, especially as the fact that the overseas vendor regime is a pay-only scheme. So the overseas businesses wouldn't be entitled to any input tax credit. So actually, by registering these businesses for GST, you're guaranteeing an increase with GST revenues for actually very little costs around the administration perspective.
Okay, thank you, Jeremy. Then now the next question is for Suhao. Now, the question here is, the rate increase from 7 to 9, do you expect it to be a 1% sort of an increase, or we just go straight into 9%?
I thought this was a free webinar. I didn't have to say anything, Eng-Min.
No.
No such thing as a free lunch.
Well, I think David sort of expressed a view that we're probably going to look at the rate increase possibly over two steps. My view is that because we are squeezing the rate increase to possibly 2023 to 2025, my suspicion is they're probably going to do it as a one-off, as a one-step increase from, from 7% to 9%. The reason why I say that is I say, the government already sort of given a lot of heads up, insofar as the rate increase is concerned. And I think, as I said, if they're going to make the announcement, and they have to make the announcement next year, right? Because we're getting so close to that period in which they have to increase the tax. So as I said, I think it will be done in one step rather than in two steps.
Okay, thank you, Suhao.
We can have a beer on it.
We will.
Right. Okay. So there are two other questions which David has already answered online. Okay, other than that, I have no other questions. Anybody has a last minute, burning questions that you'd like to ask? You can unmute yourself and ask.
And of course, please drop us a line if you have any other questions that occur to you once we've gone off. Happy to engage in a chat.
Right. So, David, if there are no other questions, I think we can end today's session.
Sorry, I've muted myself. Yes, well, thank you very much, everyone, for attending. I hope you found lots of food for thought in amongst there. And of course, as you know, we're always here to develop some of those thoughts further to help you out with any of your tax issues going forward. So even though this budget didn't really have much in it for the tax piece itself, there's still lots and lots of things to think about going forward. It's going to be very interesting times. So with that, I will say thank you, and thank you for all the speakers.